Hello, everyone, and welcome to our knowledge transfer series. Once again, we're talking about topics in the retirement space. And today I want to talk about a topic that's pretty near and dear to my heart. Something that's always kind of bothered me, in fact. It's diversification and how it could be a double-edged sword. Diversification is a word that's used throughout the retirement industry. It's used to sell people things all the time. It's used as a reason for you to do certain things. And I think there's a lot of challenges around this word diversification that I think we have to just have a conversation about, and things to kind of forewarn you or forearm you so that you're more prepared with your own finances. So once again, my name's John Erickson. I have over 17 years in the financial services industry. I've worked everywhere from a bank to an insurance company, and I've had over 10 years running my own practice. And whenever I do these presentations, I always mention that this information has to be treated as general in nature. We're trying to give real and specific information, but everyone's situation can be different, and so because of that, we have to treat this presentation as general. So today, what I want to talk about is diversification, and this is something that's actually, I think, fairly important, but also is something that has a lot of problems with it. And so I usually like to do these presentations, start with the problems, giving you an idea of either a bigger problem or why you should consider doing something, and then how we handle these type of things. So let's talk first about the problems with the word diversification. So diversification. Most people will give me the explanation of don't put all your eggs in one basket, right? You don't want to be someone who puts their money into, say, one stock, a company stock, say you worked at it forever, and then have Enron happen where you lose everything because the company goes down, because that did happen to a lot of people. But once we get past this idea of don't put all your eggs in one basket, this is where the word diversification is going to break down, because it actually can mean different things based upon what your goals or mindset is. And one of the ideas is let's say I want to diversify you, and I'm diversifying you across cryptocurrency. I'm trying to diversify you against options, all sorts of things that would be higher on the risk spectrum. That is a diversification strategy, but most people, when they think of diversification, they think about making themselves safer, which in some ways that diversification strategy would make someone safer, but it would be very risk-adjusted high. And having a very risky strategy may not be in someone's best interest, but I could throw the word back at you, well, that's diversified. And so when we talk about diversification, there's so many different ways to look at it or consider it. I think we need a better way to use this word about goal setting and what you're trying to do, right? And when we talk about all these different ways diversification works, we have to have this idea that it takes time and energy to handle diversification. And, when we talk about diversification, it usually means lower risk for lower returns, right? The more diversified you are, it means also typically you're going to have less returns. And the more diversified you are, those lower returns may not always be in your best interest. Where conversely, there's a strategy called the YOLO strategy. You only live once, right? Where you're, in a high-risk investment, trying to knock out of the park and have life-altering money. Well, that strategy, which is more risky, that can actually create not just life-altering money on the positive, but on the negative as well, right? And so, this idea of, what is diversification? What does it mean to you? I think is challenging, and that's what I want to talk about today. And let's start here with the idea of diversification and returns, this problem you see right here on the screen right now. When we talk about diversification and returns, I always say that in retirement planning, returns matter. You can't guarantee it, but they matter. You should know what your return numbers are. And on here is an example of three things that, depending upon your view set, at least two of these are probably you could consider diversified, right? The Vanguard Life Strategy Growth Fund is a diversified strategy aiming at growth. And the Vanguard S&P 500 ETF is based upon the top 500 companies from the ETF's opinion, or the index's opinion in the United States, right? You could say that those two things are diversified, in fact, very well. And then you look at Microsoft, you could say that Microsoft is a mega corporation, and it diversifies across all sectors. It diversifies heavily because it's so big that it kind of dabbles in different things. Though I wouldn't consider Microsoft on its own to be a diversified strategy. But there's a cost to going from Microsoft to the S&P 500 to a more broad-based, diverse strategy. And you look at these long-term returns, there's this trade-off here. And I think one of the biggest problems when we talk about diversification is that in the industry, we are really averse to talking about returns to you because returns can lead to lawsuits, right? If I say you should be making 7% and you make 5% or you have a negative number, well, I better have good documentation because that could lead to a lawsuit. But if I say I'm just going to diversify you and we ignore returns, then there's a lot less likely chance I'm going to get sued. And so we sell diversification a lot in the industry and we don't always talk about the returns, and that's a problem. And when we really dive into this, look at this concept of the Magnificent Seven. I work out here in Bellevue, Washington, and so a lot of the clients I work with work in the tech industry. And when you're used to tech industry returns, where you are part of the disruptor that really made it, and think about the Rust Belt, in the 60s and 70s, right? There are times where people work with certain industries where they have market-busting returns. And if this is your viewpoint, if this is what you want to go for, and we're talking about a diversification strategy, we may not be aligning whatsoever because you're used to working at Meta where you had a 200% return in 1 year, and I'm like, hey, I want you to get 6% in retirement, right? So, once again, understand the problem. When you diversify, you're usually losing these returns to go for some lesser number, and that has to be part of your goal, and there has to be a reason for that. Now, BlackRock creates this chart, and I look at it all the time. I think it's a really cool chart, though lots of places create this, and it's by generally asset class, what is returned, what's the winning asset class by year, right? So in 2015, it was Japan equities. In 2023, it was U.S. equities, right? The loser in 2015 was commodities. The loser in 2023 was China equities. And it gives you kind of an idea of how different asset classes perform over time. But when we're talking about diversification, we start diversifying across asset classes, there's a problem this chart actually shows that you may not be realizing immediately. The U.S. and things like the S&P 500 has been so dominant for such a long period of time, technically, that it's starting to break up some of the diversification strategies we use historically, because if you were trying to diversify across asset classes, you're like, well, I want a little U.S., I want a little international, and that way, I spread out my risk and I'm more protected that way. Okay, that's not a terrible idea, but the problem has been historically that, if you are an investor and you look at what has done well in the past and you're just buying those things, there's a decent chance that won in the future, because U.S. equities over the long term, over 10 years, have averaged around 12% returns, and nothing else is necessarily competing with that number. Japan equities 6.8, infrastructure 4.9, European equities 4.6, REITs 4%, right? If you're trying to diversify across all these asset classes, and then you're trying comparing it to U.S. equities, you're hurting your returns of U.S. equities to get some protection. But over 10 years, that protection hasn't been that relevant if you really look at this chart. There are times when U.S. equities is down, but not that down. And if you were diversifying into the wrong things, you actually just materially hurt your returns. So there's been this problem about diversification, and it's been going on for a while, that if you just bought things like tech historically, if you bought things like the S&P 500 historically, and anyone diversified against that, they might have just been losing on returns. And until this changes, it's actually a challenge with diversification. You have to understand, because if you're expecting an S&P 500 like return, and someone diversifies you across asset classes because they're trying to protect you from U.S. based risk, well, if status quo continues, you're going to see lower returns. And diversification is big business. I alluded to this before. In fact, I added it to a video on sales tactics I used for retirees. And diversification is big business. You can go to almost anywhere from places that want to sell you mutual funds, ETFs, advisory services. They want to sell you annuities. They want to sell you clicks, right? Their news media trying to get you to click on their articles. Diversification is a big tactic to get you to click on things, buy things, do things, and move. And it's also somewhat of a safe tactic because it's hard for anyone to ever sue someone for diversifying them. I remember one guy told me that he put almost all his clients in a balanced fund. And he always said, because who's going to ever sue me for putting them in a balanced fund? And, in hindsight, I'm like, that's not a crazy mindset. You hurt their returns, but that's not a crazy mindset from a compliance standpoint. And so there's this problem we have between diversification and returns that you have to kind of always keep in the back of your mind. The last problem I see with diversification is that, a lot of times when we talk about diversification, it's such a big term that I don't know necessarily what you think about the word diversification means, and you don't know where I'm coming from the word diversification. And there's all sorts of stories that I run into where people are working for a corporation, they get called by their 401k company, and the 401k company wants them to be hired for an extra fee to do their investments for them. And they're sold this concept of, I'm going to diversify you, right? Because remember, diversification is a major sales tactic. And sometimes that's in your best interest, but sometimes you want S&P 500-like returns. Sometimes you want to try and beat the S&P 500. On the other side of the equation, sometimes you want no market risk or no market downside. You have emotional issues that come into diversification, right? Sleep at night concepts or, fear of missing out on the big returns, right? So what I always try and figure out, especially when I'm working with someone, I think you should try and figure this out for yourself, is what do you want this to look like? Like, and this is why I think returns really matter. What do you want your basis of this to look like? And then what are you diversifying against? And so a way to think about this is think about the S&P 500, a good solid core position for a lot of people. It has clear risk, right? Every once in a while the market goes down. It's based upon the U.S. economy. Is that what you want to diversify against? Because if you know that that's what you're trying to do, you're trying to achieve this over here and also diversify against it, I think that's a better way to do it than just buying a diversification strategy without knowing what your goals were. Now, I kind of harp on diversification in a lot of my presentations, and it's partially about the sales tactics about it and just kind of the problems I see in the industry around diversification. But you really should consider diversifying. It's actually something I do believe in pretty well. I tend to work with retirees or soon-to-be retirees, and I'm forever trying to get them to diversify. And, if you worked at Microsoft forever, as an example, and you forgot in the 90s that Microsoft's stock price was kind of didn't go down too much, but didn't really go up. You might have forgotten that, looking at the last 15 years and sometimes generation-altering wealth you've gotten. And so there's this problem diversifying of, maybe we need to take less risk or more risk for someone. And here's one of the first problems we run into that you need to consider is this issue of timing, right? Market cycles can take 10, 15, 20 years, but there usually is a reverse at some point. And, even using the U.S. economy as an example, which has a long-term history, if you look at the long-term charts of the U.S. economy and the U.S. stock market, it's the winner, basically, for most situations. Not always, but long-term, it's a pretty big winner. And even when we consider that, we use like the S&P 500, which has a huge historical history you can look back on. There are times where it's not always a winner. And so one of the basic, initial starting points we'd like to start with is, okay, we have something called a core holding, right? A core holding is something that has a long-term predictable return that's not guaranteed. But it usually is going to have a problem at some point. So you need to diversify from it because of timing. We just don't know when your bad timing is going to occur or not. When you diversify based upon timing, you're typically giving up returns for that protection component. And there's another issue with things like, say, the S&P 500, is this issue of concentration. So remember earlier when I was talking about asset classes, and I said, sometimes what investors do is they buy what won, last year, and they see how it worked out. And if you look at recency bias, it's actually been, what's usually happened is that's worked out going forward, especially for like diversified strategies like U.S. growth or the S&P 500. Usually when you saw that big number and you invested in it, it worked out the next year. But what's happened over time is it's become a little bit of a self-fulfilling prophecy where certain corporations in the U.S. are becoming such dominant players in the market that when you're diversifying now, you could run into a problem if one of these companies runs into a problem. This could actually cause widespread market issues. So concentration is actually starting to become a bigger and bigger issue in the S&P 500. It's an issue on both sides of the equation because so much of the returns are generated based upon this concentration. But by concentrating, if something does break, you're going to run into a problem. On the other side of the equation, and this is usually the people who are diversified, who are not diversified, but they're really conservative. Inflation is an issue. Inflation is one of the big ones that keeps me up at night. It's one of the ways I can break a financial plan. And if you use like a CPA inflation calculator, you'll see in the last 10-ish years, you're looking at about 3.2% inflation, roughly. Okay, it depends upon your time frame. There's a little bit that's going there, but let's say 3.2 is a good solid number. And then if you were to compare that to a conservative asset class during this time period, you kind of just add it up and divide it by 10. You can see that they would be returning like 1.5% over the last 10 years. And what we're seeing overall is that, except for very recent bias, most of the time, last 15 years or so, conservative asset classes aren't keeping pace with inflation. And that is a problem when we also add in that these asset classes people take income from oftentimes, right? People oftentimes live off their CDs. They oftentimes live off interest from their investments. And so there's this, like, when we talk about being super conservative and then we look at inflation and you look at you taking income off of it, it can actually create a pretty bad spiral on your retirement assets if you live a long time. And so inflation is a major issue you have to consider. Another reason you should consider diversification is stress management. We are humans, and humans experience stress. And, there are all sorts of psychological organizations that will, measure people's stress in retirement. And money is one of the top stressors for people in generally, right? So not only when people retire do they kind of lose a sense of self and they kind of feel like they've been set on the ocean oftentimes from time to time, but then when we talk about your money, you're going to start looking at the market differently because you're paying attention to it every day. You're going to look at inflation and what you spend money on differently because you're seeing it every day and you don't have that buffer of working anymore. And when you add all these stressors together, I think people should diversify just so they can have some stress management. And you should diversify around life events so you just know if this thing happens, I'm going to be okay. I think for a lot of people, this is an important concept to consider. So some suggestions about diversification, right? What should you do to diversify? Well, I don't like people just diversifying based on market downturns. I think that's a really important one to diversify on, right? That's the reason's number one on my list, but it shouldn't be the only one. You also need to consider inflation, right? So this is why returns matter because you need to protect yourself from the market going down, depending on which market you're talking about. But you also need to protect yourself from inflation going up. So you got to find that sweet spot where you're not pushing your return so low and you're not pushing your market risk so high. Returns matter. You should always, when we're talking about diversification plan, you should always figure out what your average return is across your money in ideally each segment of the diversification. Belief in your strategy. Remember that stress management component? Stress management is an important thing in retirement. And belief in your strategy and just that confidence in it, I think is really important. And understand just risk and reward go hand in hand, right? If you want S&P 500 returns, you're taking S&P 500 risk. And there are times that doesn't work out. So how do we handle this in our practice? So, how are we trying to wrap all this information together? And, when we talk about how we do things in our practice, I'm hoping that a lot of times people will copy us actually, because I think we do some things pretty well. The first thing is rates of return matter. We're always calculating across a diversification strategy what the potential rates of return are for the overall strategy and each subcomponent. Can't guarantee it, but you should have a basic estimation, right? You don't drive down the road to go to dinner without a basic idea when you're going to arrive. We like a 3-bucket retirement system for diversification of income, growth, and protection. We like to know what someone's income plan is and actually align the investments towards that, how they intend to grow their money to beat inflation, and what's their protection from downturns and market risk. We prefer a mix of growth, guarantees, and liquidity. So we talked about those events, market downturns, inflation, you live a long time, or early death. Each of these has different problems you have to solve, right? A market downturn is you need a guarantee, typically. You need something to protect you. Not always. You can do lower correlation as an example, but you usually want some type of a guarantee to protect you from market risk. Like a CD has usually a guaranteed component by a bank. Inflation, how do you protect yourself from inflation? Well, you need growth. You need something that's going to outgrow inflation or at least keep pace. You live a long time. This is where growth is going to really matter. But also, living a long time and early death, you need liquidity events. In your retirement years, there's going to be issues where you need to get big chunks of money. And so when we talk about all this diversification strategy, there's always this component of how does someone get out $100,000 from a tax efficient standpoint and from a good investment standpoint in all of these other conditions occurring. And then, once again, people are human, and there is a diversification strategy that's right for someone, that's not going to be right for the next person. But how you look at your life and how you manage your stress is really important to us. So we're here to help. I hope these videos are useful. I hope it gives you an idea or some insight into diversification in the industry. If you have a question for us, feel free to email us or call us. If you're looking for a relationship with a financial planner, I'm out here for that type of situation. But beyond that, we'll have some more videos for you, and we'll keep these knowledge transfer sessions going. Thank you.